And so this comes up a lot because infinite banking policies are very premium hungry. The insurance company wants you to pay a lot of premium. In fact, there's some insurance companies that won't accept less than, I think, 10. I've worked with a company once that didn't want less than $10,000 in annual premium. And you have to keep paying these premiums for decades on end. That's kind of the whole point. And what makes these policies so stable and really very cash rich over long periods of time. It's not something that you fund with a small amount of money and then just leave it alone and don't do anything with it. It's also not like a savings account where you can just kind of put money in ad hoc and you don't have to worry about it, and you don't have to make consistent deposits or anything. No, they want you to make premiums regularly, and it's baked right into the contract. You have a guaranteed monthly premium that has to be paid. Now, there's lots of different ways that you can pay it, but at the end of the day, it has to be paid. So whether it's you paying premiums out of pocket or whether it is the policy getting to a point where it can essentially fund itself, one way or another, those premiums have to be paid. So what do you do if you just don't have a lot of money to fund it right now, whether you've already into a policy for a couple of years and something's come up and you have to reduce the premium, or you're starting a policy and you're trying to rack your brain, how am I going to come up with, all this money to fund this thing? So there's basically 10 easy ways to do this. It's not the only ways, but these are 10 ways that you could do this. The most obvious being just paying off nagging debts, those things, little things, if you have a couple $1,000s in credit card debts, get rid of them, especially if the payments are getting kind of burdensome. I mean, if it's a high interest credit card and the payments are just enough where it's just annoying, just pay the thing off. And then also just other, if you have other debts, work on paying those off to a point where you can afford to then start funding a life insurance policy. The other thing you could do is use cashback rewards credit cards. This is somewhat controversial, I realize, because the whole point of getting out of debt is to not be in debt, and credit cards are sort of a symbol of debt. But there's a lot of credit card companies that offer sign-up bonuses, very generous ones. And I'm talking $500 to $1,000 if you spend a certain amount within a certain time period. So those can be really good if you need money and you need to raise a lot of money in a very short period of time, talking 2 to 3 months. And you can raise $1,000, $2,000 very, very quickly. On top of that, the normal cashback rewards that you would get from a credit card. These can range from 1% up to, I've seen high 2.5%. I've seen 3% cash back. I've seen cards that will give you 5% cash back if you're spending money on certain things. Category bonuses or whatever. Those can be really generous in terms of the cash back, and they can help you kind of save enough that you can then either pay off the debts that that I mentioned before, or if it's something, if you're using a cashback card to actually pay off. If you're using a cashback rewards card to pay normal monthly bills, then that's something you have to pay anyway. You might as well get cash back for that. You could theoretically generate enough cashback rewards that you could afford to then fund a new life insurance policy. You can use rebate sites. These would be websites that you have to log into the website and then shop through the website. Top Cashback is one of them. Upside, Be Frugal, things sites like that. So you basically log into the website and then you shop through the website, and then the site itself gives you cash back. Every time whenever you buy something through their website, and they partner with normal retailers like Amazon and Walmart and companies like that. And basically what they're doing is they're getting, essentially they're getting a kickback and they're sharing that with you. And it's profitable enough for them. They're still making money off of it. They're just kind of, splitting whatever they're getting from these other sites or these other companies are splitting that money with you. Another way you could do this is to liquidate savings accounts, bank CDs, money markets, any low yielding assets that you have. Life insurance is, over the long term, life insurance is usually going to be a better alternative, or let's put it this way. It's going to be a higher yielding alternative than many other types of fixed interest. It's essentially basically you think of it, if you're just thinking interest rate wise, is a fixed interest product that often performs better than fixed interest products, comparable fixed interest products. You could refinance and consolidate high interest debts. That's not as, I guess, attractive as it used to be, since interest rates are rising as at the time of this recording. So we went from a period, very long period of almost 0% interest rates. Now, even mortgage rates are about 8%, and they're climbing at this rate. So, still credit card debt is still 24%. So if you have credit card debts, those would be the debts that you would refinance into maybe a lower rate. If you could consolidate some debts and move from like a 24% average interest rate on debts to maybe 8% average interest rate, or 6 or whatever percent interest rate on debts, that's going to still save you a lot of money. An obvious one would be simply to increase your income. Most people think of ways like, how do I find ways to scrimp and save? Sometimes the answer isn't scrimping and saving. Actually, a lot of times the answer is to make more money. That's how you make saving money easier. You can make a spending priority list. This is a tactic I learned a long time ago. It was in a different context, but I think it's applicable here. You make a list. Essentially, it's 3 different lists. One is essentials, things that you have to have. The second list is negotiables, things that you don't have to have. They would be nice to have, but you don't absolutely have to have them. So it's almost like take it or leave it kind of things. And then the third list is things that you don't need, or things that are actually just getting in your way. And this requires a lot of self-reflection and honesty. These are things that are harmful or in conflict with your long-term best interest. And so you make a list and you fill it with these different items. Things in your life that are essential, you obviously go in the essentials list. And there's a tendency to inflate this list. Everybody thinks they need more than what they actually need. Just write down what you actually need to survive and live a reasonably comfortable life. Negotiables would be things that are nice to have. It could be certain memberships to certain things, or subscriptions that you have to certain services. Maybe it's purchases that would be nice that if you could have them. Maybe you would like to have a new car, but you don't necessarily need a new car. It could be a lot of different things that are things that you would like to have, but just aren't absolutely necessary. And of course, the third list of things that are kind of roadblocks to what you're trying to accomplish. These would be things that you're spending money on that are preventing you from saving money. And these could be anything from entertainment expenses that are actually sucking up a lot of your time and making it harder for you to make more money or accomplish long-term financial goals. It could be a gym membership that you don't use and haven't used for 6 months. It could be a subscription to streaming service that you haven't used, or a streaming service that is just costing you a lot of money and is actually not contributing to your long-term financial goals. You could also hunt for deals. Go out of your way to find ways to save money. You might have to get creative with some of this stuff. It could be a matter of, I know this could sound cliche at this point, just given what we've gone through through 2020 and 2021, 2022. But for those listening in the future who maybe forgotten what it was like to live through the pandemic of 2020, maybe an idea would be buying a chest freezer and buying a whole bunch of meat or other frozen items that you're going to use, that you're going to eat throughout the year. Buying in bulk, especially if it's massive amounts of food, you can often save a substantial amount of money. You could take advantage of, I can remember when I lived in New York, we had access to farms where you could go and buy, half a cow or a quarter of a cow or what. I mean, you basically buying beef in bulk, and the farmer would give you a tremendous deal on that because you were buying so much of it. And, you could at that time, you could buy beef for a very, very low price if you're buying a side of beef. It was an amazing deal. Even if you can't do that, you can still save money by buying in bulk. You could use the 10% rule, which is before you spend any money, the first 10% of everything you make just goes into savings. That's sort of an easy shortcut to get around having a bunch of hacks and like life hacks, I guess they call them. Just take the first 10%. You don't have to do any gimmicks. You don't have to download apps for this. You don't have to play games. You don't have to gamify your budget or anything like that. Just scrape off the first 10% of everything you make and put it in savings. As simple as that. Ultimately, it's going to come down to you being more creative with how you spend your money. If even when you're making more money, you still have to, in some ways, be creative with how you spend it. And so the last idea is to simply invent your own money saving ideas. You could read 1,000 blogs, and they're all going to give you very specific, do this, not that type advice. That advice may or may not be good, but ultimately it's not going to be applicable to you. There's certain things that may be applicable and then some things that are not as applicable. But the best money saving tips and advice are going to ultimately come from inside your own brain. You know your life better than anybody else. Years ago, I wrote a book called Business Economizer. And in the book, I go through an exercise that teaches the reader how to be more creative. It's a skill you can learn. And the more you do this exercise, the more creative you can be. And you're ultimately being creative in the sense of figuring out more and more ways to save money. But the ultimate goal is being that you're decreasing the need for you to rely on financial gurus and external authority figures to tell you what to do to save money, because you're going to come up with the best ideas anyway. And all of these ideas are, if you're really focused on getting an infinite banking policy, those ideas are all going to be kind of funneled towards that end goal of getting that policy and funding that policy so you can do what you want to do, build financial security for yourself and your family. Some other ideas that might also be beneficial, if you already have a policy and you could use the waiver of premium rider if you become disabled, that would be an option. It's a kind of a special use case for that. Most people forget that they have that rider on their policy. It just the agent put it on, they just kind of forgot about it. That rider is activated whenever you get disabled. You have to show the insurance company proof of disability and wait out the waiting period. And then after the waiting period, the insurance company will waive the premiums that are due on the policy. Under normal circumstances, if you're not disabled, which hopefully you aren't, and most people don't go through a lifelong disability, it's usually a short-term thing. If you need to, if you just find yourself in a tight spot where income is down or you're spending a lot of money elsewhere, you can use the premium offset option or sometimes called alternate pay option on your life insurance policy. And the way it works is you use accumulated dividends and a combination of accumulated dividends or paid up additions and current dividends that are being paid to pay the base premium due on the policy. And this alternate pay or a premium offset can be turned on and off as you need it. So if you're taking out a policy loan and you just kind of have low funds for a while, you can kind of scale back your premiums that you're putting into your policy, pay off the policy loan, and then go back to your normal premium schedule. If you were given a substandard rating because of build, height, and weight, or for some other reason, like you're smokers, you got a smoker's rating, you could quit smoking. I know that's easier said than done, but if you quit smoking and you wait a year, sometimes insurance companies require 2 years, you can go back to the insurance company and get re-rated as a standard or non-smoker in this case. You might even get a better than standard rating. As an option, if you lose weight, if you're overweight and you got rated for that, you lose weight, you can qualify for potentially standard or a better, maybe preferred rating. And that's going to save you a substantial amount of money. Going from smoker to non-smoker is a huge deal. You save a lot of money. I can think of a case of a client who the difference between a smoker rating and a non-smoker rating for them amounted to over $300,000 on their policy. You can also use a blended whole life policy. For infinite banking. The infinite banking practitioners don't like this. Their standard way of designing policies is to use base and paid up additions. And they have mostly ideological reasons for doing this. But they'll say that it's dangerous or risky to use a term rider. It could be if the policy is designed incorrectly, but there's ways to do it where there's not much risk and you can actually just chop that risk rate down. And as long as the agent is testing the policy to make sure that on a guaranteed basis that term rider is paid off, so regardless of what happens, the term rider gets paid off, then those term riders will be fine on the policy. So you use a combination of term, base whole life, and paid up additions, and you can actually save quite a bit of money doing it that way, because if you ever need to scale back on your premiums, you can take it the normal scheduled premium and you can reduce it a lot lower than you could if you had just the base and paid up additions. And that can help you get out of sometimes a sticky financial spot. And if you just can't afford the premiums associated with getting an infinite banking policy, again, these are high premium infinite banking type policies. They're high premium policies. So if you just can't afford it, and it doesn't it's not a matter of I have to, cut back on certain expenses or whatnot. Even if that doesn't do it, then or making enough money to say maybe right now you just can't get a second job, or you can't make more money for some other reason. Start with a convertible term insurance policy from one of the major mutual insurance companies. Pick a mutual that's more friendly to the infinite banking concept, because some mutual companies don't like infinite banking. As a policyholder, they won't tell you that you can't borrow against your policy, but they really frown on the idea of designing a policy for infinite banking. So choose a mutual that is more friendly to infinite banking. And then you could start with a term policy that's convertible into one of their whole life policies. The term policy is going to be a lower cost, lower premium. What it does is it preserves your ability to get a policy later. So if you get a term policy now and 5 years from now you're not insurable or you wouldn't get the same rating, the term policy will allow you to convert your term into whole life at the same rating you got. So if you got a preferred rating or preferred plus or whatever, you'd get the preferred or preferred plus rating. Whereas if you waited, you might not get that. I think though ultimately it comes down to prioritizing your infinite banking policy. Sometimes you just have to kind of focus and nose to the grindstone and make get rid of some expenses, get rid of stuff in your life that is kind of getting in your way of being able to do this, and focus and prioritizing the premiums payments for your infinite banking policy. And when you do that, I think long term, in the short term it usually causes some pain, but in the long term you'll be building real long-term financial security for yourself and your family.